Thanks for tuning in to Retiring Well. Got a great show lined up for you. Talking through an IRA exit plan. Is the government's plan the best plan for you? Along with that, how does a fixed indexed annuity work? There's a lot of talk about them, but a lot of misunderstandings in the world today. Along with that, inflation isn't dead yet. How to protect your retirement and ultimately set up an income plan that'll last for your entire retirement. And lastly, a marketplace insurance rundown. So often, people that are retiring prior to 65 are confused when it comes to health insurance. So let us help you understand that a little bit further. So all this and a whole lot more coming up right here, right now on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Welcome to Coffee Talk here on Retiring Well. I'm Mark Canfield, welcome with John Torbet, senior partners here at Centennial Wealth Advisory. John and I have been best buddies all the way back since the kindergarten years. We've grown up here in Traverse City, beautiful northern Michigan, went away to college at Grand Valley, and now back here raising our families and partners here at Centennial Wealth Advisory. We're sitting out here today over coffee talking about some retirement topics that are commonly brought up to us with the various individuals that we have or see in the office here. You know, years ago, John, we used to sit down, not over coffee, probably over Mountain Dew or something, and trade basketball cards and stuff like this. A little different topics nowadays, huh?
Yeah, most definitely. Now it gets into the fun stuff like required minimum distributions. I mean, who doesn't want to spend their time talking about that? But that's one of those areas where when you come to like your IRA and retirement, I feel like it's talked about, but not everybody fully understands. And so it's one where as you get older and you get into the 70 plus age range and everything, that's where these required minimum distributions pop up, and ultimately it's the government's plan that they've laid out for us, right?
Absolutely. And we always kind of challenge people, you know, when we look at these, it's very easy, you know, time flies, right? And it's very easy for these required minimum distribution timelines to kind of creep up on you, and not many financial advisors help you plan for these. And it's not a bad thing, right? The government, basically, the IRS, is forcing you to take some money. And so it's a good thing because that means you have the IRAs to start with, but is their exit plan the best for you? That's really the question, right?
Right. And so recently we had a client come into the Traverse City office that they basically just started working with us, and they're in their 70 plus age range and everything, and they didn't really have a plan. Their previous financial advisor hadn't really mapped anything out. They said, oh, you'll be fine for retirement and everything, so you've got enough money to retire, but they'd been sort of pushing off their distributions from their retirement accounts, not really worrying about it, saying, oh, I'll deal with it when the time comes. Well, then all of a sudden they got into a position where their parents had passed away, and they had done a nice job saving for retirement, so they now received an inherited IRA. So with that, when a grandparent passes away and you're the beneficiary, now it becomes an inherited IRA, and then depending on their age, there's a certain distribution timeline that you have to follow, and again, all taxable dollars. So you have that, and in the meantime, they were in the process, they had sold a rental property that they had, and so now we're talking about, okay, not only do they have the distributions coming from this inherited IRA, but now they're going to have these capital gains on this real estate investment. And so again, it was one of those times where, as we were talking about it, of, man, I wish we had the opportunity to talk with them 5, maybe 10 years ago to start contemplating, hey, what are these potential scenarios that may come up that are really going to end up hurting you from a tax perspective in the long run?
Absolutely, John. I think that's really key. When you hear of anything we're talking about here, think about that. Like, just a little bit of planning in the front end could help with some of these things. There's some of these events pop up that are unforeseen, right? We can't plan for everything, but if we start working on these things and chipping away from them earlier. The story I have and makes me think of this is a couple here that's lived in Traverse City their whole lives. They've worked in the community, and they had a rental property as well. They had tucked money away in their IRA religiously and been saving with that. And they had, in their early years of retirement, they were spending down their savings, thinking they were winning because they weren't paying tax for several years, right? It sounds really good. Hey, I'm not paying taxes. I'm not spending any taxable money. They had that rental property. Well, they got to a point, you know what, I don't feel like managing that property more. Of course, they depreciated that property. Capital gains hit, required minimum distributions hit. Guess what? Now we got increased tax bracket, capital gains, and they were over 65, so now they're paying that IRMA cost on their Medicare Part B. So kind of the triple crown in a bad way.
Yeah, that IRMA piece really catches people off guard when you have too much income and then your Medicare premiums go up, and that's a whole nother topic that we won't get into here. But as we're talking through these concepts, again, it points to if you don't have a plan for your IRA, you need to come up with an exit strategy. So here at Centennial Wealth Advisory, we sit down with clients, talk through how do you transition away from taxable dollars to hopefully tax-free or after-tax dollars. If that's of interest to you, we welcome you to give us a call.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future.
Hey, super excited about this segment on what is a fixed indexed annuity. And so I have a list of kind of the most common questions that we field when people ask us about annuities. And so I have Leah here. She's a rock star out of the Cadillac office, and she's going to get to answer all of these questions. And the goal here is, the same kind of goal that people that come into our offices are really seeking. They're seeking education. They want to figure stuff out. And they know and they trust us that we're not going to sell you something. We're just going to coach you through, and we're going to teach you to the point of a decision. And that's what makes our jobs really powerful, and it makes a lot of responsibility on our shoulders, because there's big concerns that people have when it comes to their retirement. Am I going to run out of money? Do I have too much risk? What are the non-market risk options out there? So we're just going to spend some time diving into what a fixed indexed annuity is. So Leah, can you talk to us, what is a fixed indexed annuity and how does it work?
So a fixed indexed annuity is a contract between an individual and an insurance company for a fixed period of time. And it's an investment vehicle that when the contract is put in place, it eliminates the downside or the loss of the market and limits the upside or the growth of the market.
Okay, so what are some pros to these kind of policies?
So some of the pros that come along would be like the tax deferral. So if it's in your tax plan to continue to kick the can down the road. It would be, another one would be no hidden fees. So this is something to look into from insurance company to insurance company, and understanding is a huge part of that. Another one would be principal protection with no market risk. And then the final one would be to link your funds to an index of your choice that the insurance company offers, such as like the S&P 500 or Tech Index.
Awesome, awesome. So yeah, what I heard you say there is each insurance company have different products, and so is there any pro in where you get these indexed annuities, as far as the type of organizations that are independent or captive?
Yeah, something to for sure be on the lookout for is you want a firm that's independent that can shop all the best insurance companies and the best rates there.
Awesome. Okay, now what are some cons or some things that people want to know about and be careful of?
Some of the cons would be the reduced liquidity. So because it's a fixed period, sometimes there's surrender charges that come if you do that before maturity, or there's the limited growth to this product.
And with these fixed indexed annuities, you can choose different indices that you want to track. But what about the typical term length? Like how long are these policies typically?
There's policies, it depends on kind of what you prefer, but they can go from 4 years, 7 years. I think we've done a 12-year maybe too, so it just kind of depends on your plan.
Yeah, and it depends on what the client wants and how long they want that particular instrument in their toolbox for. Cool. Now let's get into some examples of how they might work, and we'll try to keep it super simple as far as like, let's just track what index?
The S&P 500.
Okay, so everybody sees the S&P 500 index, on the nightly news. So how these will work is you have a 1 year point-to-point time where when the investment is issued, then what happens is you have a 1 year where nothing's going to happen. But then 1 year later, you look at where that index, the S&P 500, is in comparison to where you started a year ago, and that's where some good things can happen. So let's say that, or let's talk about what are some average, I mean, these always are changing, but just for examples, okay, and for illustration purposes, what are some typical rates you might see on an indexed annuity?
So like one that we recently looked at was with a cap rate of 10% and a participation rate of 50%.
Okay, so we'll use those as an example. So let's say 1 year later, the S&P 500 was up 16%. If you were in the cap strategy, what would you earn?
10% of that.
Cool. And then if you were in the participation strategy, what would you earn?
8%.
Cool. All right, then this is what everyone wants to avoid, and these are why you might want to look into these. What happens if the S&P 500 is down 30%?
You make zero. You don't lose any though.
Right. You didn't make any money, but yeah, just don't look at the market risk side of your portfolio, because this is where that principal protection comes out. Okay, so that would be true on both the cap and the par?
Yes.
Cool. All right, now there's a rebound year where the S&P does 30%. What would your cap be?
Your cap would be 10%.
So you'd make 10% on that year. And then what about your participation?
You would make 15%.
Okay, cool. And then finally, year 4, just for our illustrations, let's say that you made, the S&P 500 made 8%.
You would make, for the cap, you'd make 8%, and for the par, you'd make 4%.
Awesome. So, these are a way to educate you, but all of your situations are going to be individualized, and I implore you, challenge you to always put learning first. A learning heart is the best way to go through life. And if you want us to help, we'd love to teach and to coach, so you can call any of our offices. And so I hope you have a great day. Thanks for watching. We appreciate you.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
When I think about current inflation, I almost think about this lurking sea monsters kind of sitting out there just waiting to pounce on us. We saw inflation peak in 2022 at about 9%, but things have really started to come down. When I say inflation has come down, that doesn't mean your prices are going down. That just means they're going up at a slower rate. But when we look at kind of the historical inflation, we're sitting just under that 50-year average right now. But it's important to think about, we're seeing this battle right now between potential fiscal policy and current monetary policy, where we could see inflation potentially tick up. And it's important that we start to look at what is the impact of that to our actual retirement plan, and then what can we be doing today from an investment standpoint to protect against that income component of our portfolio by having inflation going up. So I built out just a kind of basic retirement plan assuming a 3% inflation rate. So this is made up data. We have John and Jane, both retired, Social Security, pension income, have their house paid off, then we have some investment assets. We'll assume that their investment assets are all pre-tax accounts and growing at about a 5% growth rate. What you'll notice in this first scenario is at 3% inflation, they really don't need to touch those investment assets until they get into their mid-70s. And when we go out, to the later end of retirement, their assets are projected to last them to age 99. So from a base scenario, they're in a pretty good spot. Now, we may want to do some additional stress testing for this and look at alternative scenarios, but the main thing is, what if we look at inflation going at 4%? And why I chose 4% is that's just above that 50-year average. What you notice is when they start accessing their money is a lot sooner. That inflation catches up to them. It doesn't have as much of an impact on the 3% rate as it does at 4%, but we're seeing inflation really erode that portfolio value a lot quicker. And then again, if we look at the later years of retirement, we see they run out of money 10 years sooner. So 1% change in that inflation rate can have a pretty dramatic impact on their retirement portfolio. Now we're in a situation where we probably have to think about maybe making some lifestyle adjustments or maybe making some changes to their current portfolio. But this is just a base scenario, not assuming tax rate changes, not assuming bumpy markets, just a change to the inflation. So a very small tweak to that retirement plan going to have a pretty dramatic impact long term on how long their assets are going to last. So then the big question is, well, what can we do today? Well, it really comes back to your current asset allocation. We typically talk about stocks and bonds, but it might be time to think about how do alternative investments fit into our portfolio. An easy way to protect against inflation is increase our income. A way to do that is have more yield on our portfolio, have a little bit more dividend, more income producing type investments. Alternative strategies, whether that's private equity, private credit, they can offer some of those solutions. Same with bonds. People tend to move to the bond market to have a little bit more yield, a little bit more income there. We want to be careful though. Again, if the Fed does increase interest rates because inflations go up, that can cause a little bit more volatility in that bond portfolio. So if we're going to have more bonds, just be careful in how we do that. Same with stocks. When we look at stocks, the historical average, the compounding annualized growth rate in the S&P going back to 1957, adjusted for inflation is over 6%. A lot of growth opportunities out there in the equity market, albeit we're at all-time highs. So we want to approach that with caution, but there's still some opportunities in these different asset classes to start to make some adjustments to your portfolio to offset that risk against inflation going up. So I'll leave you with kind of two different thoughts or three different thoughts. When was the last time you actually took a risk questionnaire on your portfolio? As we meet with individuals coming to the Traverse City office that see the TV show, pretty much nobody has actually taken the time to take a risk questionnaire to actually understand their comfort level with risk. So we might say, well, let's go have stocks or bonds or alternative investments. But if it doesn't align with your risk tolerance, it's probably not a great solution to this inflation piece. The next thing is, are you actually diversified in your investment portfolio? The number of client meetings I have, when I just ask, what are you currently invested in? Well, diversified bunch of mutual funds. What does that actually mean? Have you actually looked inside that mutual fund to see how that fund is actually allocated? Is it stocks, bonds, international? Does it have some alternative investments in it? What are they actually buying for you inside of these different funds? But taking a step further, a way to protect against inflation is taxes. Are we diversified from a tax location? Not only just asset class, but also by strategy, passive versus, more proactive investment strategies. We want to be diversified in all these different areas. The last thing is, plan. We want to build out these alternative plans as we looked at today, have some goalposts. We don't know where inflation is going to go, but we do know it can have an impact. So if we can build out these different plans, build investment strategies to align with those worst case scenarios, that's going to set you up for the best chance for success in retirement. If you have questions, please feel free to reach out to us. If you want to do a deeper dive into your investment portfolio, portfolio, we're happy to sit down and dig into that with you. Or of course, check out our YouTube channel to see alternative videos on these different topics.
Finding a reputable business shouldn't require luck or chance. But how can you tell who you can trust? Pro tip, the BBB connects people with businesses they can trust. So think of the BBB as the better, check with the BBB first, because better businesses are honest and commit to high ethical standards bureau. That's why they're better. Always look for the sign of a better business and find a better business anytime at bbb.org.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time, we'll have reports that show us the percentage of assets currently in high-risk vehicles, as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, and to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
Health insurance for retirees under the age of 65 is often one of the main fears that they have when they're retired, next to, well, running out of money in retirement, right? So let's try to alleviate some of those fears by going over some tips for marketplace insurance, because marketplace insurance is the primary way that you're going to get health insurance under the age of 65. Now, there are a couple different options that you could have. One would be if you are lucky enough to have a pension, and health insurance is offered when you retire with that pension. But in today's day and age, pensions have really gone by the wayside. Another option outside of marketplace insurance is through what's called COBRA. COBRA is basically a continuation of your current employer coverage, but you're limited to how far you can actually carry that in retirement, and that's up to 18 months. So if you retire a number of years under the age of 65, most likely you're going to end up on marketplace insurance. So let's go over a couple tips for getting signed up for marketplace insurance, what it covers and so forth, to help alleviate those fears that you might be having. So first tip number one is when to enroll. Well, you want to enroll right when you retire, okay? You don't want any gap in your coverage, so you want to do that right away. If you wait and think about it and you wait longer than 60 days, well, guess what? you got to wait till that open enrollment period, and that starts November 1st and then runs through January 15th. So you really don't want to wait. You want to do it right away. Now, if you do it right away, you qualify for a special enrollment period. Okay, so right when you retire, this qualifies you for that enrollment period. Other things that might qualify you would be moving or having a child or getting married, things like that. But when you retire, you get to qualify for that special enrollment period. So you have a 60-day window, and you can do your research and really dive into those details and figure out which marketplace plan might meet your needs best. Okay, tip number 3. Most people do qualify for savings. Okay, so what does that mean? Well, marketplace insurance is all income based. And so what marketplace does is they look at your income and they say, okay, based on this income, you qualify for X amount in government subsidy to help offset the cost of your health insurance. So let's run through a quick scenario here. Let's say that we got a married couple, both age 62 in Otsego County, and they have $60,000 of income. Well, based on that income, they would qualify for $1,721 per month to help offset the cost of their health insurance. So with that great subsidy and lower income, they can probably find a zero premium marketplace plan. Now, with that being said, the deductibles and max out-of-pockets are probably going to be a little bit higher, but it's a great starting point, and with that lower income tier, you get a great subsidy. Also, you can check out all this information on healthcare.gov. Type in your information, go through the application and so forth, and really do your own research on all the little individual details. But tip number 4 is what they cover, okay? So marketplace plans are obligated to cover certain things. So the first one is they have to cover 10 essential benefits. So some of those benefits are like emergency care visits and so forth, but there's a whole list of 10 there. And then they also have to cover preventative services. So there's a very large list of preventative care services. You want to go to healthcare.gov and check that list out. And then finally, a lot of big concern is around pre-existing conditions. Well, marketplace plans do cover those pre-existing conditions, so you don't have to worry about that. And then tip number 5 is how to enroll. Okay, you can do it multiple different ways. Like I said, you can go right online to healthcare.gov. You can also go and give them a call and talk to a representative right through Marketplace. But another option is to talk with us. Here at Centennial Wealth Advisory, it's not all about investment planning. It's looking at the whole picture. Retirement planning involves, yes, investment planning, but tax planning and also health insurance planning. So I'm a licensed health insurance agent. There's a couple other people on staff as well that are licensed health and insurance agents, and we'd love to go over your situation and help you figure out what marketplace plan might work best for you.